You very much for attending the seminar, and good morning to everybody. What I would like to do is to go through my presentation and then answer questions afterwards. So, but let me give you an idea of who I am. I'm a partner in a CPA firm of Phillips Company, which is located in Pasadena, California. And I'm also president of Downstream Exchange Company. My background is that I have a BS in accounting from Drexel University in Philadelphia, Pennsylvania. And then I have 2 master's degrees, one a master's degree in finance from USC and here in Los Angeles. And also I have a master of business tax, again, from USC. So that gives you a little bit about my background. What we're going to cover today is the pre-exchange qualification of a property. And then also we're going to talk about briefly the current status of Section 1031, and then we'll take some questions and perhaps have some further discussion. So let's kind of get into it. There's actually a section of the code that says no gain or loss shall be recognized on property held for productive use in a trade or a business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or a business or for investment. That actual section of the code fits on 2 8.5 by 11 pieces of paper. And it's a very simple code section. However, because it's a big benefit to the taxpayer, the IRS has litigated practically, and the courts have litigated practically every word in that section. So as a consequence, the regulations are very voluminous, but even more importantly, there is court cases, revenue rulings, revenue procs, a whole series of legal documents that really basically define how you should review Section 1031. Now, if you read the code, it sounds simple, but then you have to have that knowledge of what happens in the background of Section 1031. And that's what we're kind of trying to get a little bit of familiarity with. The actual, you wonder, well, why has Section 1031 become so popular? I mean, everybody knows about it. Everybody's heard about it. It's just an extremely popular section. Well, what happened was in 1986, what's that, 44 years ago, they made some changes to the tax code. And what they really did was, back in 1986, we actually had a flat tax system, which was interesting to me. And what they did was they made capital gains higher. They made the minimum tax prior to 1986 was 20%. They made it 28%, which was a 40% increase. So they increased the capital gains tax, and also the maximum tax rate was 28%. So in effect, we had a flat tax system in '86. However, of course, Congress couldn't leave it alone, and they kind of slowly changed it to what we have today. But that's just the way it is. Our current tax is now 15 and 20%. If your adjusted gross income exceeds, I think, $400,000, no, if your taxable income exceeds $400,000, you're in a 20% tax bracket. So generally, you're in a 15% tax bracket. However, the recapture depreciation is still 25%. And back in, the Obama era, they added a 3.8% Medicare tax. So although people will say, oh, capital gains are fairly small, it really works. And also when you add on the California tax, it's the 15%, well, it's actually 25% plus roughly 10% for state and plus 3.8% for Medicare tax. So it's not that cheap. So, all right, so there are various kinds of exchanges. There's something called a simultaneous exchange, and that means that the the sale date occurs on day one and the replacement property is acquired on the same day. That's simultaneous. And you'll notice that very few escrow companies are willing to do simultaneous exchanges, because unless it's really in the same escrow company, they're reluctant to do it, because if it's in two different escrow companies, it's their responsibility to have a exchange close on the same day. Or if it's in two different parts of the state or two different states, it makes it very difficult. So what you really kind of see is something called a delayed exchange. And what a delayed exchange says is that you can acquire a piece of property on day one, and then you have to identify a piece of property by day 45 and acquire that piece of property by day 180. That's the most popular exchange. You also have something called a reverse exchange, which says you can acquire your replacement property and then sell your relinquished property. And that can happen within 180 days. There's also a build-to-suit exchange, which we find is very popular, where you acquire a piece of property and then either build a structure on it, but mostly repair a structure, and that requires 180 days. There's also a tangible personal property exchange, but that can only occur in California since they changed the law. There are kind of three requirements that you have to do or meet when you have a 1031 exchange. The property that's given up and the property received must be held for productive use in a trade or a business, or held for investment. That's the first requirement. The second requirement is that the property must be exchanged solely for property of like kind. All right. And then the third requirement is there must actually be a reciprocal transfer of property for another property. Those are basically the three requirements that you have to meet. We notice in our particular exchange practice that there's a lot of related property that's being trying to be in exchange, and it's really kind of generally occurs between families where father and mother are trying to transfer property to siblings, or siblings are trying to exchange property between each other. And there's some special rules that pertain to that kind of exchange. And really the basic rule is that both the exchanger and the related party must hold property received for 2 years. The object, of course, is to discourage the perceived abuse of basis shifting among related parties. And I think the IRS is kind of using a shotgun when they're trying to, should use a rifle, but the related party rules are in the body of law, so you have to follow them. The exchanger exchanges property with a lower basis and purchases higher basis from a related party. And what they're trying to do is they're trying to sell the highest base property and keep the lower base property. So that's what the IRS is trying to prevent. But again, the important thing is both the exchanger and a related party must hold on to both properties for 2 years. Well, I guess the real question is, who are related parties? And brothers and sisters, spouses, ancestors, and linear descendants. So it goes this way, father, mother, brother, sister. Also, more than 50% controlled corporations are related parties. And we find a lot of people are trying to move property in or out of corporations. 2 corporations, which are a member of the same control group, they're related parties. A trust, or any person who's a grantor or beneficiary of the trust. And we kind of run into this quite a bit. And also 2 trusts where the grantors is the same. And again, we've run into that many times. So, and also a trustee and a beneficiary of another trust were the same person as the grantor of both trusts. And it's kind of funny, every time we run into trust, I have to kind of look at the rules again. A corporation, a partnership of the same, or the same person owns 50% or more of the stock in a corporation, and more than 50% of capital or control partnerships in the partnership. I mean, again, these are all kind of very specialized circumstances where you have to kind of, at least I have to look at the rules every time. Also, certain 501c3, 501 exempt entities where the person controls or the family controls the entity. And again, we've had that situation, I think maybe 2 or 3 times in the last maybe 2 years or so. So I think the rules that we have to kind of follow is an exchanger can exchange with a related party. They can do that, okay? So, party A gives up property A and exchanges for property B with a party B. That can occur. But, and also the exchanger can sell to a related party because the exchanger then goes on and acquires a new piece of property. An exchanger, but the big thing is that an exchanger cannot purchase from a related party unless a related party accomplishes an exchange. Now, what I would suggest is that you remember that you can't use an accommodator to mask the exchange, but if you are or feel that you're in a related party circumstance, consult an accommodator because it's very complicated rules. And the reason I'm discussing it is we've run into it several times, actually more times than that. I don't know, maybe 15, 20 times in the last year where there's been related party exchanges. There's some exceptions to the related party rule, which says, you have to hold on it for 2 years. Of course, one of them is death of the exchanger or related party, but that's pretty severe tax planning. Or compulsory involuntary conversions, that's also kind of an exception. But the one exception that they have, or the final exception they have is the exchange or disposition was not principally designed to avoid income tax. And we've yet to figure out what that means, because obviously you're trying to avoid income tax. And there are very, very narrow circumstances where that has worked to the benefit of the taxpayer. So again, if you find yourself in a related party transaction, please consult with an accommodator. One of the questions people have is, can we refinance? Well, you obviously can refinance before you do an exchange. You can't refinance when you're in an exchange, but you can refinance after the exchange. So you can refinance before the exchange, or you can refinance after the exchange. But you can't have the financing set up to occur because there's a famous court case that there has to be a nanosecond, 1,000th of a second, between the time you acquire the replacement property and the starting of your refinancing starting of the process of refinancing the investment property. But the major thing is that you just can't get into an exchange and decide, oh, I want to refinance it, because you cannot refinance during an exchange. And basically, it winds up that you receive something called boot during the exchange. So a lot of people ask, can I refinance the property? Well, the answer is yes, if you can do it before or you can do it after, but you can't refinance during the exchange. Now, you have these delayed exchanges, and as I said, that's really the most popular exchange that we do. Well, there's some time limits, unfortunately, with exchanges. Basically, you'd like to have unlimited time to accomplish the exchange. However, the IRS has decided, the IRS, that's a regulation. The IRS has decided that, no, we want to put so many restrictions on exchanging that are designed to make you fail. And people have asked me, well, why is it so hard to do an exchange? Because they want you to fail. They want you to pay the tax. All right, so the first restriction you have, the first time restriction you have, is the replacement property must be identified within 45 calendar days, not business days, calendar days, after the close of escrow of the relinquished property. That means if the 45th day falls on a Sunday, or Saturday or Sunday, you have to identify that Saturday or Sunday. It just doesn't roll over to the next Monday. All right. Also, the exchanger must send a written document unambiguously describing the replacement property. You just can't say it's one of those condos. You have to say it's condo number 203. The next requirement is the escrow of the replacement property must close within 180 calendar, not business days, from the close of escrow of the relinquished property. The 45 days runs inside the 180 days, so the total exchange period is 180 days. If you have a tax return due during the tax year, then you must get an extension. And if you kind of look at a kind of a time limit or a timeline, let's assume that an escrow closes on December 30th. December 31st is a year end. 45 days falls on February 13th. You have a tax return that's due in normal circumstances April 15th. You must get a extension for that particular tax return that's due so that it takes it out, then the 180 days is June 27th. So you must get an extension, take it out to October 15th. So if you find yourself in that circumstance where you kind of have an escrow that closes, around, let's say, around the end of the year, you have to have the taxpayer get a extension on their tax return. Now, some of these things that we're talking about, they're really not in the bailiwick of the realtor. You really just got to get an accommodator who knows what they're doing, and the realtor's job is to find the replacement property, obviously, or to sell the relinquished property and to find the replacement property, and then have an accommodator kind of guide them through these little requirements. The next question you have is, well, how many properties can I identify? I mean, you really want to take the county assessor's records, throw them on the accommodator desk and say it's one of these. But again, the IRS and their wisdom of trying to make it hard for you, they say, look, we'll allow you to identify 3 properties, and you can identify any property of any value. All right. The hard question is, if you identify more than 3 properties, then the more than 3 properties cannot exceed 200% of the fair market value of the property you gave up. All right. So that means if you had a property that you sold for $100,000 and you identified more than three properties, let's say 4, the more than the 4 properties cannot exceed $200,000. All right. When you get into this particular area where you're trying to identify more than 3 properties, again, the accommodator should guide you through that process, because even that little bit of a process has a pitfall, because there's something else called the 95% rule. And it says, if more than 3 properties are identified and the fair market value exceeds 200% of the fair market value of the property, of the relinquished property, then you have to acquire 95% of them. That absolutely makes no sense whatsoever. It just doesn't make sense. How do you acquire 95% of the properties? It just doesn't make sense. So again, if you find yourself in a situation where you're identifying more than 3 properties, you should work very closely with the accommodator. All right, now let's talk about the current status of 1031. As you can imagine, the IRS is constantly trying to amend 1031. It's been around since 1922 and in one form or another, but they've, I mean, they look at it as a tax on the rich, I think. And if you kind of think about it, you can sell a piece of investment property and buy another piece of investment property and pay no tax. That's a good deal. All right. So obviously the IRS, when they start looking around for increases in taxes, they always look at 1031. And they have this situation where they say, gee, if we did away with 1031, it'd yield a significant amount of revenue. Well, obviously, if you did away with 1031 and you are, let's say you're over 60, you're kind of reluctant to pay that tax, and you'd probably keep that property. So I don't think it would raise as much money as they think it would, but they still always look at it. In 2017, in the Tax Cuts and Job Act, they preserved 1031 only for real estate transactions. All right. So what they did was they eliminated exchanges for tangible property. They eliminated exchanges for intangible property and retained only real estate assets. Well, obviously that was good for the real estate industry, but it wasn't good for the auto industry and other intangible. Well, it wasn't good for the auto industry because of the exchange of automobiles, or it wasn't good for real property. It wasn't exchange. That's real property. Real estate, not real estate. Wasn't good for furniture and fixture companies. It just wasn't good for tangible property. And if you kind of think about it, it wasn't really good for the hotel industry, because in the hotels, obviously, you have not only the real property, the hotel itself, but you also have tangible property that furniture, beds, TVs, things like that. So at least to preserve the ability to exchange real property. Okay, now we're down to questions. Hopefully there will be a significant series of questions. Stephanie, what is our what would be our first question?
Let's see. So we have more, let's see, this is kind of a comment question. One of the attendees is saying they had a condo in Las Vegas in an LLC and wanted to do an exchange with the house in California. They found out that they first take the condo out of the LLC before they could start the 1031 process. They didn't do it in time, so they couldn't do the 1031. And they were both hold titles to the property and the LLC. So I don't know if there's a follow-up question tied with that, but that person made that comment. But that's the only comment we have so far in the chat box.
Okay, that's an interesting question because what happens is banks don't like lending to LLCs. And what the bank will do is, if you have it in a Nevada LLC, they will want to have you take it out of the LLC, and then acquire the replacement property in an LLC, or not an LLC, acquire the replacement property as a personal asset, and then they will allow you generally to put it back into an LLC. But then you got to look at the LLC, because if it's a single member LLC for internal revenue purposes, it's considered a disregarded asset and disregarded entity rather. And you can either do it inside the LLC or do it personally held asset, because since the LLC is a disregarded asset, then it just seems like it doesn't exist. However, if it's a multiple member LLC, that's where the problems usually develop, where you have, let's say, more than 2 members or more than 1 member having the, what do you call it, the LLC, then that's an issue. IRS has generally looked the other way, where you have to take it out of the LLC, put financing on it, and then acquire another asset. Generally, they kind of look the other way. However, I don't like depending on the largesse of the what do you call it, the IRS. One of the common questions is, what is like-kind property? Now, we've used that term quite a bit, and what happens is, under most state laws, there are 3 kinds of property. You have real property, you have tangible property, and you have intangible property. Those are the 3 kinds of property. Tangible property is property you can touch, such as furniture and equipment. And then intangible property is property you can't touch, but it has value, such as trademarks and goodwill. You cannot exchange real property for tangible property. That's unlike-kind property. You cannot exchange tangible property for intangible property. That's not like-kind property. But under current federal law, you can only exchange real property for real property. That's like-kind. So, you have these 3 kinds of property: tangible, intangible, and real. You have to stay within those kind of guidelines. That means you can exchange improved property for unimproved property, or you can exchange city real estate for farmland, or you can exchange 5 of 6 tenants in common can exchange where the one doesn't exchange, or you can exchange 2 properties for 1, or 1 for 100, or you can convert the character of the property. You can convert the character of the property from residential property, property yes, you live in, your principal residence, and you can convert that to rental property. And vice versa, you can convert rental property into investment property. Leasehold interest of more than 30 years, that's considered real property. But the only thing you can't do, of course, is no foreign property can be exchanged for domestic property. And then I think they put this in the code, I think just for laughs, but livestock of different sexes are not like-kind property. Under that kind of little bit of information, if you think about it, a single family frame home can be exchanged for a duplex. A duplex can be exchanged for a triplex. A triplex can be exchanged for a fourplex. A fourplex for a 6-unit apartment house. A 6-unit apartment house for a commercial building. A commercial building for an office building. Office building for raw land. All right, those are all like-kind property. You can also exchange, interesting enough, timber cutting rights in Oregon for an office in California. Timber cutting rights in Oregon are considered real property rights, so therefore real property, timber cutting rights in Oregon, can be exchanged for an office building in California, real property in California. Another question people ask is, what is property held for investment? Now remember, we talked about there has to be property held for investment. And it seems like a fairly simple term, but again, that's the thing that the IRS has litigated over and over again. Basically, they like to see property rented or offered for rent that's considered business property. Raw land or net lease property is considered business property. Any combination of business or investment property will qualify. Now, the real question is, how long do you have to hold it before it's considered for investment? A lot of people think, oh, gee, I can buy a piece of property, fix it up, and flip it, and do that all within a 6-month period of time. Well, that's property that you obviously didn't hold for investment. That's property you held for resale. So question becomes, how long do you have to hold the property? Well, if you hold a property for 10 years, that clearly is for investment. I mean, you rented it out for a 10-year period of time, that clearly is property held for investment. Well, what about property held for 5 years? Again, 5 years is probably sufficient time. What about property for 2 years? Well, the IRS back in the 70s tried to pass an amendment that said, we'd like to see you hold the property for 2 years and we'll consider it an investment property. However, Congress didn't pass that, but that kind of gave you an idea of what the IRS is thinking. And some people have kind of changed that around to say, well, it has to be 2 tax years. I really think it's just 2 years kind of thing. But what about you hold a property for 1 year? Is that property held for investment? Well, under various circumstances, yeah, it pretty much is. And that's the kind of, I think, the minimum period of time you could hold a piece of property and consider it property for investment. But what about property held for 6 months? Is that property considered held for investment? Well, there's actually a court case, 124 Front Street, that says the taxpayer held the property for 5 months, 20 days, and that was sufficient period of time to hold that property for investment. Well, realtors asked me, well, I should be able to fix this property up and flip it because I've held it for more than 6 months. But you have to read the court case. And the court case was a very specific case. The property, the investor who held the property had a big portfolio of various properties. And I think he had like 20 properties in his portfolio. And he bought this piece of property and it didn't fit his investment criteria, or it didn't suit his investment criteria. And he sold it within within 5 months, 20 days. That's a very specialized circumstance. He held property, all of his properties for more than 2 years. That one particular piece of property didn't fit his investment criteria. Therefore, he sold it. But that's a very narrow circumstance. Holding a property for just 6 months, that's not a very good circumstance. And also, realtors will say, well, there's a minimum, or what's a maximum that I can fix and flip properties, and that's 3. No, IRS has the ability to kind of look back and see that you did 3 in 2 years ago, 3 in the current year, 3 years ago. They look back and say, no, you really have a history of being a dealer in property. And also, realtors have a kind of a stroke against them in that holding a property for, holding a real estate license is the license to buy and sell property. So the IRS kind of doesn't look at that the way I think they should. All right, so are there any other questions that we may be able to ask?
Yes, we had a couple more pop in. One of them I think you kind of just touched upon, but just to clarify, if a husband and wife own property in an LLC and are contemplating divorce, can one spouse use the proceeds for a 1031 exchange rather than both of them?
The answer to that question is it depends. And you'll find most tax questions can be answered with that phrase. Depends. In California, you have community property, and that allows you to have an LLC that is owned by the community, and therefore it's considered a single member LLC, and therefore is disregarded. If it's a single member LLC, in other words, owned by the husband and the wife, then it's fairly easy to segregate the property because it's really owned by the community. One member of the community can sell the property. The other member of the community can exchange the property. That's a fairly simple circumstance. Where it gets a little sticky is where the property is owned by a two-member LLC, and that means that it files its own tax return. That has a little bit more difficulty to it, and but it can be done. You basically have to redeem the property from the LLC, and then cause it to be redeemed by a two-payment note, one payment due in the current year and another payment due in another year. But it can be done. It's a little more difficult, but it can be done. Okay.
Awesome. The next one, what is the tax consequence on cash out refinancing on an exchange property?
What kind of financing?
It says, what is the tax consequence on cash out refinancing on an exchange property?
Well, there are a number of different circumstances. Let's say you've already done the exchange. You have a very low mortgage, and you refinance the newly acquired property, the replacement property, and you take cash out. That has no tax consequences. No, I shouldn't say it that way. It has no immediate tax consequences. You can do that. You can you had a piece of property that you had for $1 million, had a $100,000 refinancing, excuse me, $100,000 mortgage on it, and then you refinance it and borrow, let's say, $500,000 on it, and you pocket the other $400,000. There's no tax consequences or immediate tax consequences. But where it does have tax consequences is there is still that gain in the property. And when you go to sell the property, you could very wind up with, well, not that particular circumstance, but you could wind up with a lot of taxable income, but no cash. And let's assume that you had $1 million property and you refinanced it for $950,000, and your gain on the property was $500,000. You could wind up with you could wind up with gain but no cash. So it's okay to do. It's just that you have to be careful when you go to sell it. Okay.
The last question I have so far, is there any benefit to the agent for doing a 1031 exchange?
What kind of exchange?
Is there any benefit to the real estate agent for doing a 1031 exchange?
Oh yeah, of course. Because hopefully you get the opportunity to acquire the replacement property. I mean, and also well, let's focus on that. You have a listing to sell the property, and you sell the property. Well, I mean, you have contact with the seller of the property, and you would of course encourage the seller of the property to use your services to find the replacement property. Or if the replacement property is in a different state, you certainly will at least seek a referral commission. So yeah, there's a big benefit. And also, you want to look around to see if there are any other assets that the client may want to sell. And also, let's say obviously they're selling not an investment property. They're selling excuse me. They're obviously not. They obviously are selling an investment property, and there's their principal residence. And typically, you'll find that people are kind of readjusting their portfolio of assets. Typically, a person is moving closer to where their grandchildren live. And of course, they always live in a different state. So you may be selling their investment property, but then you, of course, want to inquire about the listing of their principal residence, because they may be selling their principal residence. So I think there's tremendous benefit. And also, if you do a good job, I mean, who else are they going to talk to?
Thank you. And then we had one come in. It's understood that DST stands for Delaware Statutory Trust. Can you explain what Delaware Statutory Trust is?
Yes. I'd like to explain, before I explain what a DST is, what a TIC is. There is something called a tenant in common interest that was very popular, pre 2008. And what a tenant in common was there was a bunch of people who acquired like a trophy building and acquired it with tenant in common interest. Well, the tenant in common was considered a real property interest. There was a big hassle about whether it was a security interest, but it was a tenant in common interest. Well, when 2008 hit, it turned out that that wasn't a very good way of acquiring interest in a property. So what was later developed is something called a Delaware Statutory Trust. And as you can imagine, it's a Delaware entity, and it's a really kind of a trust. But then again, that particular interest, property interest, was considered a real property interest. And the difference is that you don't own a piece of the asset. It's owned by a trust that owns the total, participates in the total asset. So it's a kind of a better form of ownership. And it's the differences are subtle, but it's just a better form of ownership. Okay.
That's the last one that I see, unless anyone has something else to add to the chat box. That's the last one I see.
Okay. Well, thank you very much for attending. And then if you have any more questions, you can kind of contact me at 626-796-1031. My extension is 202. And I can answer, hopefully answer most of the questions you may have. So again, also too, how many people think I look like Tony Bennett in this picture? I think I do. Okay, so thank you very much for attending. I appreciate your attention, and sell real estate.